everyone. So I think we'll just begin in a minute. Thank you everyone for joining. Good afternoon, everyone. I'm Shwetank, part of Nasscom Insights team. I have with me Dhiraj Sharma, part of Nasscom Insights team, and we both are here to provide some coverage from the recently released Nasscom's startup tech startup report 2025, in which we looked at the calendar year 2025 in terms of what are the key trends and what major developments happened. And we also did a comparison with some of what happened on the global level, and what happened with India, right? So, and the scope of this report is to do with the tech startups, and this is like a 12-year in continuation. In fact, 13 years in continuation that we have been doing this report. It's one of the flagship reports of Nasscom. Uh, so, without further delay, I would like to just quickly kick off this webinar. Uh, but before that, thank you everyone for registering, and thanks for taking time out to hear us. Before we proceed ahead, I'll just quickly share my screen. Just give me a second. Thank you everyone for your attention. So we'll quickly begin this webinar. So if you are aware of what this report was, so the title of the report was Momentum to Maturity: India Startup Ecosystem at a Strategic Inflection Point. As I said, this is, I think, this is the 13th edition of our report. So quickly, I think when we look at the global tech startup landscape, or the startup landscape, uh, we see that it is defined by the capital concentration, AI-led scale, and ecosystem selectivity. And some of these trends we see, playing out at an India level as well. AI is certainly one of them, right? So at a global level, right, when we look at the funding, so 65% of the funding actually flowed into the mega rounds, 48% of funding captured by AI companies. US captured 70% of global venture funding, and funding favors scale category leaders over early experimentation. So there were numerous examples from the ecosystem where we saw the mega rounds happened. They came back again, and this was largely to do with some of the major bigger companies. AI has become the operating layer of global innovation. So AI accounts for 50% of venture funding. This number is not that high for India when we do that benchmarking. However, it's AI is one of the major bucket within the deep tech segment for India. Now, leading ecosystems such as Silicon Valley, Boston, Tel Aviv, and others, they are producing AI native companies, and the same is the case for India. In India, there's one more trend which is playing out, which was some of the startups are pivoting towards AI, right? So they may not have started with purely or as a pure play AI company, but that shift is very, very evident now, and it's one of the key trends. Now, frontier capital at a global landscape level is expanding into physical AI and robotics. Now, 2025 marks a structured shift toward rapid category-defining growth. So, with that, what we see is that ecosystems compete on scale, capability, not startup volume anymore, like the trend was there a few years ago. So, I think we have moved from there. Now, one key observation there is that India remains the third largest startup ecosystem, with Bangalore rising globally. So, now this has been covered by multiple reports that we have come across, and to our finding also, we found that India remains the third largest startup ecosystem. Now, with that, if I move to the India tech startup landscape and how the picture looks like, these are the three ways to kind of look at India tech startup landscape. So one of them is the capital deployment, investor behavior, liquidity and consolidation, and startup formation and ecosystem structure. Now, some of the key metrics that the ecosystem tracks and you guys may be interested in looking at is, what is the total amount of funding? Where has the funding gone? What are the segments and the verticals and the themes that have seen a major traction, and they have seen a continued traction from last year? So if you look at the total funding amount raised in 2025 and in calendar year 2025, we have reached 9.1 billion US dollars. And this is 23% increase from CY 2024. In terms of, if you look on the right side, in terms of the total number of startups, we may not have mentioned it. I think it's in the uh, title of the slide. So we have reached 31 to 34,000 startups in total. Now, this is the count of the total tech startups in India. When we break it, when we again look at the funding, so we have seen that $2.3 billion funding is raised by the deep tech startups in 25, which is again a healthy increase from to 44%. It was a 44% increase from 2024. So that segment continues to grow. Within that, we'll touch upon how AI is playing out in the later slides. Then again, hand in hand, if I talk about the startup formation, so there are 1,000 plus new startups that were funded. So these are the number of unique tech startups funded in 2025, which is again a 7% increase from 2024. And these are some of these numbers are in front of you, right? So if you look at how many mega deals have happened, so there were a total of 16 mega deals, again a good increase, 33% increase from last year. And share of funding raised by the unicorns, it was close to 35%, so it largely remained the same. Now, if we I come to the liquidity consolidation segment later, but if I look at the tech startups in metro cities, again, this trend we have seen continuing. I think till last year we saw some emerging hubs coming into the picture. This year again saw with more focus on deep tech and AI that some of these already established hubs, we call, or maybe the metro cities, the major 7 to 8 to 9 hubs that we have in India, they have seen 66% of increase in the startup formation. Now, on the M&A deals, this was an important year where we saw that the M&A deals actually doubling from 2024. So total number stood at close to 140. And similarly, I think share of tech startup M&As by Indian corporates, it has actually, this is a very important area because this shows that the Indian corporate sector actually is coming to the fore to acquire some of these leading startups and give them a sort of a helping hand to actually providing more scalability options and more commercialization options to some of these startups. So this is close to 36% share. If I move on to the next slide, now we wanted to break the funding by years to give you a consolidated picture of how the funding has been and why we see that we are again on the path to recovery. So if you look at 2021 to 2025, 2021, 2022, there was good, funding increase. But again, 2023 was that year where I think everything gone for a toss. And I think after that, 2024, we saw good increase. And similarly, the trend is continuing now. So 74% of all funding deals in 2025 were seed and early stage deals compared to 93% in 2024. Uh, Median seed stage ticket increase in 2025 as compared to 24 is 36%. So we have seen the seed stage ticket size actually getting increased. And 6 of the 16 mega deals that I talked about earlier, 6 were late stage. So there's a lot of focus on, not a lot of focus. I think I think may have divided opinion on this, but I think 6 were late stage, amounting to approximately USD 2 billion. Seed stage deals dominate each year. Early stage deals recover after 2023, whilst late stage deal flow remains weak. So I think we have seen late stage deal momentum not that much happening. So if I go to the next one, M&A trend, just wanted to focus on this. So M&A activity actually rebounded sharply in 25. So if you see some of the logos on the right, some of the key M&A deals that happened, and these are just a very sort of a illustrative view. There are many more names, but again, companies like Grow, Udan, and all these Perfios, right? So I think these are some of the names that we have put here. I think in terms of numbers, if you see, so Indian corporates actually is one of the important ecosystem player that is driving this trend. So if you look at the Indian corporates, I think there were 2025 there were 52 total percentage share dedicated to the M&A acquisitions done by the corporate sector, Indian corporate sector. Similarly, I think the other key segments are the essentially the Indian startups themselves, and the global startups as well as the global corporate sector. So I think this the segment which is your global corporate and Indian corporate, that forms like the 30% of the share this year as compared to 44%. But the base has actually increased this year if you see. So if I move on to the next one, so coming to the side of deep tech and AI, so AI anchors India's deep tech momentum, right? And we look at that, there were 550 plus deep tech startups, the new deep tech startups that were founded in 2025. This number has actually again, I think it has grown, I think in double digits as compared to last year. We may not have the all the numbers here, but I think this continues to grow. Now, when you look at artificial intelligence, this one we have seen that the share of deep tech funding and distribution of deep tech startups, both by technology and funding, I think this has been 84% and 91% respectively. So AI continues to anchor India's deep tech ecosystem in 2025, and AI is embedded across 20 plus verticals. And we've seen that it is concentrated in verticals such as enterprise tech, health tech, HR tech, ed tech, BFS, and marketing. Deep tech investment momentum remained resilient in 2025. So, which means that we have seen across different stages, whether it's seed, early stage, deep tech startups accounting for 24% of total tech startup funding. And AI funding normalized in 25 as investors rebalance portfolios toward applied deep tech and commercialization led opportunities. So with that, I'll just move on to. So I think the few hypotheses. I mean, you see some of these trends in the next two slides. We formulated some of these hypotheses, and through our primary research, talking to some of the ecosystem players and covering all the founders, etc. We have we have kind of tested this hypothesis, and if you see what we have found is there was some short micro survey also that we did. So we have seen extended stage duration characterizes startup progression. So 80 to 85% of tech startups remain at the same funding stage after 5 years. Now this is for the India startup life cycle, India startup landscape. This indicates progression barriers are structural and stage linked rather than driven by idea quality or capital availability. Similarly, another thing that we observed was seed to Series A emerges the primary conversion inflection point. So 85% of seed stage ventures do not advance to Series A within 5 years. So they're largely stuck at the same stage, the seed stage. This stage requires demonstrable customer validation, early revenue traction, and repeatable go-to-market models, which is again not happening for majority of the startups. Now, third, we found that incubation strength coexists with commercialization opportunity. So 40 to 50% of VC evaluated tech startups have undergone incubation. So this is what we found, and so but conversion from POC to paying customers remains a defining differentiator at scale stages. So which is again a sort of a missing link. Now, seed and early stage deals account for 74% of venture activity, and growth stage capital participation remains concentrated, shaping scale outcomes. So early stage capital is strong, while growth stage deepening remains selective. So this is what we found. Moving on to the next one, which is on the incubator and on the incubation. I'll just hand it over to Dhiraj to take you through the further slides. Dhiraj.
Yeah, sure. Hi, everyone. Thank you so much, Shwetank, for covering this so far. So, this year the focus was on the incubation ecosystem in the country. Just like every year, we focus on different themes. So, the four trends that we see on the screen here, they clearly define how the incubation ecosystem in India currently looks like. Right? We have achieved, and for all these years, we've been talking about the sheer scale of the incubation ecosystem in India. We have the second largest incubator ecosystem in India. We have the second highest density of incubators per thousand startups in the country, and so on and so forth. But what we see on the screen here is the reality of the space, and I'll cover it in much more detail when we go ahead. So the programs are focusing on early and a very early stage or early readiness. But then, in order to really help the startup scale, the support is lacking at all the stages. So if you look very closely, the support has been lacking consistently across all the stages. Structure and incentives that matter are not available in the ecosystem currently. Global benchmarks. So we also looked at the incubation ecosystem across different competing markets when we talk about the Indian ecosystem. And here is the contrast that we see in comparison to the global ecosystem. So if we move on to the next slide, and yeah, so here, I mean, I would just take a step back and put everything in context, because what we've heard so far and what I'm about to present hereafter. So before the link between the two is the context itself. So over the last decade, most of the conversations around the Indian tech startup ecosystem were around scale. How many startups are getting created? How much capital is coming in, how fast things are growing, and so on and so forth. But what we are seeing now is a clear change in that narrative. And I would put it in four different shifts in narratives, just for the ease of understanding of everyone. The first shift that we see is around how capital itself behaves. For all these years, we've been seeing capital was more willing to take broad bets because the ecosystem itself was still forming. When I say capital, I mean the investor ecosystem. But today that has changed completely. Investors are looking much more closely at whether a startup can actually generate revenue, whether it has defensibility, whether it can scale, and so on. The second shift is around concentration, because startup activity is no longer spreading evenly across sectors and geographies. For a lot of these years, we've been covering how many startups are getting incepted in the established hubs, how many startups are getting incepted in the emerging hubs, which sectors are getting, the highest inception of startups. But then now capital and startup creation are getting concentrated in areas where there is already some maturity and the ecosystem that has developed some depth, right? So these are sectors like AI, SaaS, it can be fintech, climate tech, mobility tech, legal tech, retail tech, and so on. So this is usually how the ecosystems evolve, because they start broad, and then over a period of time they deepen in specific areas where they see real traction. The third shift is around technology itself, because AI is no longer a vertical, because for all these years we've been talking about AI as a vertical. A lot of analyst firms have been talking about AI as a vertical, but then now AI has become the base layer across everything. So what this has done is this has made building much faster, right? But it has also made differentiation very hard. And then if something, because why I say this is because if something can be built really quickly, it can also be replicated very quickly. So the bar for what can be called as meaningful innovation has gone up significantly. Investors are now looking for clear technology depth. They are looking for category leadership. They are looking for those nuances which were missing earlier, and they are not just looking at incremental improvements anymore, to be honest. And this is exactly what we've been seeing in ecosystems like the US, China, because there the funding is concentrating in companies which have proprietary models, which have data advantage, which have deep infra layers, right? So a similar trend is starting to happen in Indian ecosystem as well. And the fourth and the final shift is and I think that is very important, is the role of corporates. Because we've been speaking very regularly with the corporates, and especially the corporates which are running their corporate venture capital arms. So scaling is no longer just about venture capital or IPOs anymore. Corporates are becoming much more active in the Indian ecosystem, either through partnerships, through acquisitions, through integrations, and so on. So, if you look at the mature ecosystems, this is a very important part of how scale really happens. Take Germany, for example. So, companies like Siemens or Bosch, they actively integrate startups into the industrial systems. Similar trend can be seen in the US, China, and other mature markets. So broadly, what is happening here, we are moving from a phase where the ecosystem was focused on just creating startups. For all these years, we've been boasting of having one of the largest startup ecosystem, to a phase where it is being tested on how well it can scale and even absorb them. So how well the ecosystem can scale the startups or even absorb them, right? So we move on to the next slide. And if, yeah, so if this is where the ecosystem is heading, then the obvious question would be, what is really slowing it down? And one of the most important observations here is that the issue is not as much about startups failing, right? Uh, we do acknowledge the fact that a lot of startups get dead pooled every year. They die in the commercialization valley of death. But then when we look very closely, the issue is a bit different, right? What we are seeing much more often is startups getting stuck, and they don't just shut down, but they don't scale either. They stay in that early stage for a long time. I mean, I have seen startups, multiple startups, stuck in their seed stage for 3 years, 4 years, 5 years, and so on. So this tells us something very important, that the system is not helping them move forward at the right time. And a big part of this comes from the gap between the technical readiness and the commercial readiness. That is what I was referring to when I was talking about the commercialization value of death in the last slide. Startups today are able to build products much faster. Talent, tools, cloud infra, all of that has improved significantly in the country. But getting from a working product to a paying customer is still very difficult for many startups. And this is where most startups really slow down. And this is also why we see the seed to Series A stage becoming much more critical today. So the investors at this stage are not looking for potential. They need evidence. They want to see customers. They want to see revenue. They want to see repeatability. The many startups have not been able to build those signals yet. Another important point that came out very strongly is that getting early customers is now harder than building the product itself. And this is where global comparisons become useful in, because if we look at an ecosystem like the US, programs like SBIR, or they have historically provided startups with early government contracts, which acts as their first customer, right? In the UK, the NHS Innovation Accelerator, for example, this creates structured pathways for health tech startups, for example, to be deployed within the healthcare ecosystem. These mechanisms have reduced the friction in early adoption. India at scale, I mean, when I talk about the broader Indian ecosystem, it still lacks these kind of systemic demand channels, which is why startups really struggle at this initial stage. On the incubation side, like I was saying earlier, we have built a very strong incubation ecosystem. When I say strong, I mean the sheer size of the incubator, not the capability. Which the having a sheerly a large size of the incubator ecosystem is the first step, right? We have managed to do that, and it is a positive, parameter for the Indian ecosystem, but most of the incubators are still focused on early stage support. They can be focused on ideas, prototypes, pitch readiness, but startups, they do get some benefit from it. But when they step out of the incubators, they still need help with customers, pricing, contracts, revenue models, and so on. This is where models like, the Fraunhofer in Germany, or the catapult model in the UK, right? These become very relevant because these are institutions which are specifically designed to bridge the research and industry adoption uh, in those ecosystems, which is really lacking in India, or maybe we can say it is still building. And finally, the drop after incubation is quite sharp. We all know that after many incubation programs get over for a startup, the support reduces significantly. I mean, I would say it completely disappears in most of the cases, and capital becomes very selective while the market access is still very unclear. This is where a lot of startups slow down. So with this, we move on to the next slide, and we talk about what really needs to change. And one thing that I would highlight very clearly is that we don't necessarily need more programs or just capital in isolation. We need to make sure that what already exists, it works together for the entire ecosystem. And another point that I would like to bring here before I jump into this slide is, for all these years, we've been making recommendations to the government, and a lot of those recommendations get heard by the ministry and the government. For example, this recommendation around having a patient capital or dedicated deep tech fund and so on, right? So, but then those recommendations required some structural changes, some new initiatives to come into practice. But this time we are, and if you look very closely, I would walk all of you through what we are covering here. But if you look closely, this is more about accountability. Now we have some system in place, but the accountability, among the ecosystem players is lacking very significantly. And so we highlight some structural weaknesses, and then we talk about, how do we address those weaknesses. So multiple structural weaknesses that we've highlighted here. The first one is a startup struggle to move from working technology to paying customers at the seed to pre-series A stage. Therefore, established we need to establish a dedicated outcome-driven commercialization organizations that actively secure buyers, validate pricing, and convert pilots into revenue. This is like I was saying, this is all about accountability. We need someone to be held accountable for the misses or the disconnects in this stage. So what the ecosystem needs to do, we need to create dedicated organizations whose sole job or only job is to help startups get real customers and revenue, not just mentorship, not just demo days. We need them to take ownership of all of this thing. The second structural weakness is the capital is getting concentrated at early stages while growth transition remains underfunded. Therefore, we need to create transition stage capital pools that deploy blended finance against revenue traction rather than valuation. So, what we need to do is, to put it simply, we need to provide special bridge funding for startups that have pilots or early revenue, but then which are not yet ready for large growth investors. The third structural weakness is the incubators. They attempt to serve all stages, but deliver inconsistent outcomes across all stages, right? So, I mean, we all know this. This does not come as a surprise, right? A lot of incubators try to serve startups across all verticals, across all stages. But then, do we ever think that the incubator might not be equipped well enough to cater to all types of startups across all stages and domains, right? So therefore, there needs to be a mandate, and the government should mandate clear life cycle based specialization where each incubator focuses on one stage, and every incubator has a defined role with aligned funding and metrics, right? And when I say this, I mean the outcomes, right? So clear alignment with the outcomes should be there. The fourth structural weakness is incubator incentives reward activity instead of startup success. And we all know this. So therefore, if we need to redesign incentives to modestly reward commercial outcomes for the incubators. And commercial outcomes can be pilots, these can be contracts, these can be early revenue, instead of just focusing on metrics like how many activities they conducted or how many events they conducted, how many networking sessions they conducted, so on, right? The fifth structural weakness is startups lose coordinated support after entering incubation during their most fragile growth phase. And this is what I was talking about a few moments ago. Therefore, we need to create a post incubation, maybe a stewardship layer that tracks progress and actively brokers capital, customers, expertise, and so on. So that, if even if a startup moves out of an incubation program, they don't lose all the support all of a sudden. The sixth structural weakness is securing early customers is the biggest barrier to scale, yet no institution owns demand creation. This is a big problem, and a lot of forums that I have been part of, a lot of accelerator programs that I've been, attending all this while, they have consistently highlighted this issue. Therefore, we need to establish institutional demand anchors that enable procurement pathways or which can share the buyer risk or which can incentivize purchases from startups. So essentially, let us make large buyers, and these can be corporates, these can be PSUs, these can be governments, and all of those players. They need to actively buy from startups, not just run pilots. And just to uh, bring in another point here, a lot of startups that I have been speaking to for all this while, they highlight that a lot of government contracts or government stakeholders, they bring those startups in for pilots, but these are free pilots. Nobody wants to do a paid pilot with them, right? Which should not happen. The seventh structural weakness is the prototype to scale journey. This lacks clear ownership and coordination. Not that I have not mentioned it already, but then this itself is a structural weakness. This itself is a key pillar when we talk about what really hinders the growth of the startups. Therefore, we there has to be formally, or maybe we need to formally recognize scale as a distinct policy domain. And this is where Nasscom's policy wing might come into play. We need to formally recognize scale as a distinct policy domain with a single accountable authority which can integrate demand, capital, and regulatory support. Because if that is not there, so no matter what we do, no matter where we want to go, no matter how many efforts we put in this direction, we are not going to get there, right? Then finally, and I mean, happy to answer questions around these. And then we arrive at the last slide of this presentation where we talk about a very broad perspective, right? If we can move on to the last slide of this presentation. So what we are clearly seeing here is not just this is not just a startup ecosystem issue. Let me put it this way. This is a shift in how innovation fits into the economy. So over the last decade, startups were largely operating alongside the economy. They were building, they were experimenting, they were raising capital, they were trying to find their place in the ecosystem. But what is beginning to change, and from this year and the last year, is that startups are becoming more relevant to how industries themselves evolve, right? So it can be mobility as an industry vertical, it can be manufacturing, it can be healthcare, financial services, all of these verticals. Across all of them, innovation is increasingly coming from outside traditional structures. I have, written multiple blogs. We have published multiple point of views around the same thing. How, and this applies especially to the corporate venture capital arms, because a lot of corporate venture capital arms that we spoke to over the last year, they mentioned this as one of the biggest, motivating factors why any corporate should even think of having a CVC arm. Because when you bring in startups, right? So you don't have to put in millions of dollars into your newly set up R&D arm. You let the startups do the R&D for you. You nurture them. They have their talent pool. They have their plan, their roadmap in place, and adopt or absorb that R&D or innovation into your business. So that's a win-win for both the parties, right? And this creates a different type of requirement altogether, because it is no longer enough for startups to be strong on their own. I mean, if the surrounding system, and when I say surrounding system, I mean the enterprises, the investors, the institutions or incubators, they also need to adapt, because innovation only creates value when it is actually adopted and scaled. There is no point of building thousands or probably hundreds of brilliant products in an ecosystem when none of that product is getting absorbed in the industry, right? Or if none of that startup is able to scale. If you look globally, the ecosystem that have matured well, whether it is the UK ecosystem or the US ecosystem, Germany, Israel, a brilliant example for that matter, they have one thing in common. Startups are not operating in isolation. They are deeply integrated into the supply chains, deeply integrated into the enterprise systems, public infra, and so on. So this is what allows innovation to scale. So the bottom line is India has a strong starting point here. We have a large market. We have real world problems to solve. We have a strong technical talent, and we have a growing corporate participation, obviously. So the opportunity now is to make these elements work together more effectively than allowing them to work in isolation. So with this, we come to the end of this presentation.